All right, I start recording, and Kashi, the room is yours.
Okay, so hello everyone. Welcome to the Accounting Design Project virtual event. My name is Keishi Fujiyama. I'm from Kobe University, Japan, and the moderator of this session. Today we have Bharat Sarath, Rutgers University. So he presents interesting research on banks' bargain purchase gains during the 2008 crisis. So please make sure you are muted unless you ask questions. But if you could share your videos to promote active discussion. So for questions, please type in the chat box or use the raise hand function. Then I will call on you in order. Okay, so the presenter may choose to talk without any interruption in the first and last 5 minutes. Okay, so Bharat, the screen is yours.
Thank you so much, Keishi, and thank you, Ayung and Steve, for allowing me to present in the seminar. We wrote this paper many years ago. This is actually part of Yan Yan's dissertation. And, we've been looking for a right time, right journal to get it in. And when the second round of bank failures happened, we thought it was time to get it back into the public domain. Okay, please ask me questions at any time. I'm very happy to pick them up. And I really want to say that this is about, really in a way, both about the, oh, wait a minute, my slide is not moving. Okay. So it's really about two things. One is the Accounting Standards 805, that really, in a way, was a very radical departure from the way accounting was done before. So I'm going to explain why it was such a departure and what made us interested in this topic. So accounting, ASC 805 flips conservatism on its head. Okay, and it's very scary in a way that this happened. Okay, the second thing is there is all this research on earnings management, and I think I must be upfront and say I never put much weight on that for the simple reason that, if you grew up learning about the principal agent model, you know that the incentive contract is what motivates behavior. And if managers are manipulating earnings, it's because they're encouraged to do so through their incentive contracts. So to view it as a plus or a minus for shareholders is somewhat dubious. And maybe I'll say something more about this as we go along. All right, so much of this manipulation is kind of obvious. So we have to ask, do people get fooled by this kind of manipulation? Or to be more precise, do accounting numbers really reflect the value perceived by investors? And that really is the focus of what we are going to do. Okay, so let me go through what was the logic in 805. Okay. So first of all, if a firm pays more than market value for an asset, they have, at least in efficient market theory, a potential loss contingency. Because they're paid more than what was the market value, presumably there is some probability that they'll lose this excess because the market is efficient. However, the loss contingency is not recognized in accounting, it's booked as goodwill. Okay, that's fair enough because maybe it's not really a likely loss contingency, so you book it as an asset. Okay, but if you book it as an asset, you have to test it for impairment later on. And the problem is that testing for goodwill impairment is not easy. So what they decided was that the excess purchase price should be allocated to intangible assets, which could be depreciated or amortized in a more sensible way. So this was the logic behind ASC 805, that don't put everything into goodwill, which is very difficult to test for impairment, put it into specific assets where the testing for impairment is a little easier. However,
Bharat,
yes,
you
Can I
have
jump in?
question?
Sorry. So I just wanted to contrast the financial reporting accounting for this goodwill against tax reporting. For instance, where the sort of life is much shorter, in say the UK, they write it off within the first year and so on. So it's sort of, and even for private firms, it's 20-year amortized life in the US. So, right?
Well, the problem, of course, is that tax is also not entirely driven by economic considerations. But yeah, the point is that this has also created a big divergence between goodwill as it's measured for tax and goodwill as it's measured for accounting. Yeah. Okay, so the point is that if there is a gain contingency after you've allocated, it is accrued in its entirety and booked to income. So what we have today is a rule where goodwill is booked to an asset, but negative goodwill is booked to income. As a consequence, potential gain contingencies, which are included in the fair value of the future cash flows, are recognized in net income, while goodwill, which you can think of as a potential loss contingency, is not recognized in income. So that's why I say this really flips conservatism on its head, in the sense that you allow the gain contingency to be booked as income, whereas you take the potential loss. If you can think of goodwill as a eventual loss contingency, it's actually accrued. Okay, so this is one of the things. The second thing is, because you had to allocate to intangible assets, what are the intangible assets that can be recognized? So you have to go, there's a whole list of this. And, you look at that and you wonder how anybody's going to value this. Okay, so the problem is these intangible assets are all very interesting and presumably part of why the purchase price was paid. But how do you value them is very difficult. Now, one such is the indemnification asset offered by the FDIC for loans. What this says is at the time of acquisition, the acquirer and the FDIC, if the FDIC is involved, they agree that some of the loans that have been acquired, that is, these are loans given by the target bank to third parties. Now the acquirer owns these loans. The more risky the loan, the bigger the problem for the acquirer. So during the crisis, there was a lot of problems about, whether these loans will eventually be paid or not. So in order to help the acquisition, the FDIC offered to pay 80% of the incurred write-offs on a select group of loans. This was not on all the loans that were acquired, but on the loans that were considered risky. This is a standard policy. For example, when Silicon Valley Bank was acquired recently, the FDIC again offered indemnification against the risky loans. Now, this was a very interesting notion. I mean, obviously it makes sense because this is risk sharing, right? I mean, you're sharing the risk of the loss with the FDIC. Now, why should the FDIC do this is the question. So now you have to remember that the FDIC insures deposits. Mainly it insures deposits under $250,000, but in a general way, it's responsible for all the depositors. So if a bank goes under, the FDIC will have to pay out the insurance claims to the depositors. As opposed to that, if they allow the bank to be taken over, they pay something to the acquiring bank, but they don't pay anything to the depositors. So the FDIC is required to find out the most efficient way for the government to deal with the potential failure of the bank. Okay. Question, Ayan.
Bharat, I have a question about when does the FDIC pays this 80% of incurred write-off? Is at a time when the merger is consummated at day one, or is actually in the future? Because this question relates to whether they can book it immediately in the income statement or they have to defer as an asset like receivables in the balance sheet.
Okay, thank you. So this is a potential, it is a promise to pay 80% of the incurred write-offs. Okay, so it's only paid at the time that the loan is written off. Okay, so that's when the actual money is given. But it's like a fund that is set up at the time the bank takes over. So you can think of this as a savings account or whatever you want, from which the acquirer can withdraw money every time they write off. Yeah, so it is very much an asset, and it is booked as an intangible asset. Okay, now the problem with this, as you can see, I'm sorry, does that answer your question, Ayun?
So when does the FDIC transfer the fund to the acquirer?
It's a contract. It's a contract that says we will reimburse you 80% for any of the write-offs on this specified group of loans.
So
Mostly they were real estate loans.
write off in the future. So if
Yes.
we, okay, so it's something
But-
more like a receivable.
Right.
Okay.
Yeah. So this is the thing, that it is a write-off in the future, and I'll get to the next slide, which will answer some more things about this. But the basic point is that this is a write-off in the future on any of these loans that are classified as risky. Okay, most of these were real estate, commercial real estate loans, and they were the riskiest during the crisis. Okay.
Okay,
Bharat,
so
I had a
we have two questions and comments.
Right,
So
right, please.
first, Sudipta, do you want to ask a question or comment?
So when you're talking about the difficulty of valuing these intangibles, I just commented that it's going to be even more difficult to audit those values.
Sorry, what? I missed the last part.
So when you commented that it's going to be difficult to value these intangible assets a slide ago, I commented in the chat that it'll be even harder to audit those values on the book.
Yeah. Well, in a way, that's an advantage. I'm sorry, I have to say that. Auditors are delighted with this because nobody can be sued for this. You know, they can write any number, like our good friend Eli Botov showed. You can put any number down and they can't question you because it's so difficult. Yeah. Somebody else had a
So-
question?
So
Yeah.
next.
Yeah, Bharat, my question was with respect to this 80% pay, to agreement to pay 80%. This clearly has some model hazard implications. And how do you arrive at this 80%? Why not 60%? Why not 90%?
So please give me a second and I will answer that. Okay,
Thanks.
so first is 80% was the most common. It wasn't the only number, but this seems to be some efficient sharing. Because of the moral hazard, they want to leave a copay with the bank, right? Otherwise, you could just write off all these loans and collect from the FDIC 80%, which is probably more than you will collect from having the loan alive. Yeah, so that is a big issue. This one reason was the 20% copay. This is why, for whatever reason, they think that this is a good number to control the moral hazard. You still have to pay 20%. Okay, that's the first thing. Let me go down to the next one. So this was my next slide. What is to stop the acquiring bank from exploiting the indemnification provision? Okay, so they had some built-in safeguards, and to me, this was the most interesting part, from a real-world perspective. First of all, if you don't, so remember, but this goes back to Ayun's question. The money is set aside at the time of acquisition, right? It's like a savings account. Now, if you ask for too large a savings account and you did not use it, you have to pay an interest charge on it. Okay, so that's the first thing that they did. The second thing that they did was that you cannot write off these covered loans in a way that is different from the way you write off your ordinary loans. Yeah, this is the second way that they control the moral hazard. You could not accelerate the write-off of this. Okay, the third thing is the copay on the write-offs. You still face a cost if you write off the loan. So these were the three things that they used to try and get the indemnification asset, to get the banks to be upfront about what they thought was the risk. I want to stop here because after this we won't talk about this, so I'm willing to answer any questions that you might have about this asset, which is a very interesting economic asset in its own right. Yeah, Steve?
Okay, should
Let
I?
me let me add one thing that when you're looking at business combinations or particularly business acquisitions, the thought by the regulators was you would hardly ever see an acquisition where the fair value of the assets you get exceeds the acquisition price. In other words, you wouldn't see these bargain gains in particular. And surprisingly, when you look at acquisitions and bank acquisitions, you see a subset or another set of firms that have bargain gains without acquisitions. So there is a tension here of the concept of managing earnings. Why would somebody be as foolish as to give a bargain? And the intersection with a regulator who comes into these banks and gives an indemnification contract. And that was one of the things we saw throughout our research. And it was an awakening, if I can add it, to me at least, and I think Bharat would share that, to see that there's a subset within this where you have this other ingredient added to business acquisitions of an indemnification.
Thank you, Steve. Yeah, well, I'll get back to that a little bit about how frequent these are. Surprisingly frequent, and that itself is unusual. Shuai, you had a question? Oh, yeah.
Yes, I have a question about the write-off because when a bank write off the loans, they can still collect the loans in the future, right?
They have
Even
the
though
option,
they
yes.
write, yeah. So my question is, if the banks recover these collections, will the 80% reimbursement by FDIC will be, returned back to it, or?
Yes, there was some more details about clawbacks. I didn't put it in, but there are some issues about clawbacks in these agreements. Yeah. Most of the time, you're quite right. When you write off the loan, it means that you write it off for book purposes, but you still, subcontract it to the mafia or somebody like that who can collect it for you. So that's something that goes on. Absolutely right. Yeah.
Yeah, I just feel like this can cause the incentive for moral hazard for the banks to over write off.
Exactly. And I think that, as I said, that's a very interesting sub-issue in its own. And there is, in fact, a case that I was following where the FDIC sued the bank for improperly writing off loans. Yeah. Sharita?
So I wanted to inquire again into the tax treatment of this. So when you write it off, are you going to be able to deduct it against your income for tax purposes? At what point will that happen, et cetera, because there's also a tax benefit to be thought about, right?
Just your share of the write-off.
Yeah.
So
Okay.
only your share of the write-off will be a loss for tax purposes, not the entire loan. So the 20% copay you can use as a write-off loss in the standard sense that any bank can use as a loss, but not the amount that is recovered from the FDIC.
Bharat, I'm going to go back to moral hazard issue. So yeah, good to know that there are some checks on exploiting the moral hazard situation. But do you think that this percentage that is determined for how much will be reimbursed should somehow take into account the riskiness of the original loan? And how does that 80% indemnification is very good if your original loan riskiness is it's a risk-free loan. It's almost no cost to FDIC, but it is not enough if it is a very risky loan. So how is that controlled? And, what is the mechanism for that?
Well, why don't you give me some time? Let's go to
Sure.
the actual thing. Next slide, I'll try and answer that.
Okay, thanks, Bharat.
Okay. Anybody else? Let me go to the next slide then, which shows a lot of the stuff in an actual. Can you read this, Ayung? Keishi, is this readable or it's too small?
I can see, I can read, but
You can read? Okay.
yeah,
So I want to go here to this thing that says FDIC loss share receivable. Okay. So to first answer Ayung's question, this is clearly an asset, right? This is part of the value. Okay. So this is in there as an asset recoverable by the company. Okay. So this is part of what is received in the acquisition. Okay. Now I want to draw your attention to this less asset discount. Okay. So this is a discount on top of everything else which was given to the acquirer. So if you look at this, you will see that the excess of assets received over liabilities here was 97,421. Okay. And on top of that, they got a discount of 123,000, which resulted in a cash received by the acquirer of 25,759. Okay, so what you have to do in this thing is there is the indemnification asset. On top of that, there is an asset discount. Okay, and these two together really compensate the bank for taking over this risky person. Now, to answer Atul's question, I think that some of the moral hazard issues are dealt with in here in the asset discount, which can be moved up or down based on how the FDIC feels about the whole acquisition. Yeah. So just to complete this is the M&A paper, and part of the indemnification contract efficiency, if you like. On the one hand, you first designate some loans as eligible for coverage. That's step one. Then you reimburse not 100%, but 80% of those risky loans. This gives the bank an incentive to try and collect these loans because they still lose 20%. And the last part is you negotiate an overall asset discount, which itself takes into consideration the entire value of the acquisition. I want to pause again, and this is the whole thing of the bargain purchase gain here.
okay, Surita, do you want to ask a question?
Yeah, I have a couple of questions. So the cooperative bank is the bank that's acquiring or the one that's been acquired? Because I have another column on the right.
No. This is the bank that is acquiring.
Okay. And then the fair value adjustments, what are they? I mean, are they to...
The fair value adjustments are negotiated. Again, these are based on the bank's own assessments. Of course, they are approved by the FDIC, but you can see that this is almost exactly 80% of this fair value adjustment. Can you see it's 227?
Mm-hmm.
Almost 80% of that is this 185,112. If you multiply 1 by 80, you'll get very close to the other one. So the basic point is that the fair value adjustment, which they expect to lose, is partially covered by the indemnification.
Okay. And the second thing is for the other loans that the bank has, how do the loan covenants address this?
Which ones are you talking about, sorry?
So when the bank is getting financing, right? Bank is debt financed, right? So how are those covenants dealing with
Banks
this? I
own
mean, are
debt?
they,
Sorry, the acquired banks.
no, the acquiring banks
Acquiring bank, yes.
is financed by debt mainly, right? Only 3% is financed by equity. So 97% is financed by debt.
Oh, yeah, from that, yes,
Yeah.
okay. So you're talking now about the acquirer's own equity. Yes, go on.
Yes. So I'm talking about the acquirer's debt. So the debt
Right.
has covenants, and how do the covenants take into account? Do they take these assets, this intangible as an asset or not. So if they're relying on tangible net worth, this
Oh,
doesn't count
you
as an
mean-
asset.
Are you
And
talking about the tier one capital ratio?
all of that
How to
stuff, yes.
calculate that?
Yeah, all of that
Okay.
stuff.
So we'll say something about that, but this is we have something on that a little later on. Yes, these numbers do go into that. Okay, so basically it's just an aggregation of whatever they had before with this value, and then you recalculate your tier one based on these numbers for the acquisition. Okay. Any other question? Keishi, may I ask you a question? You said that this happens often in Japan.
Hmm?
I ask you what the difference is. I was going to ask you when it came here, because what would be the extra asset? If you think about it in this context, what would be the adjustment? You see, there has to be a positive adjustment here. A difference between what is paid and what is got. Do you know where the difference comes in, or is it a different kind of accounting?
I'm not familiar with the bank accounting.
Okay. Okay, we can talk about it later. I was just
Okay,
interested
yeah.
by the fact that, I think that they're doing it on a somewhat different basis, because I cannot see how you can generate negative goodwill out of future costs, but that's a
Yeah.
different issue. Okay.
Mm.
Yeah. I am.
I just want to confirm, so what's the amount will be recognized as gain in the income statement?
Right. So the 67 is what is recognized as net income.
Okay,
The 67 goes on to all these others go on the balance sheet, and the net of 67 goes on the income statement and then into retained earnings to balance out everything.
okay.
Yeah.
So to
So-
summarize, the 67,000 gain has two pieces. One is today FDIC transfer 25,000 to
Right.
the acquirer, and also in the future, FDIC already put aside 80% of today's anticipated fair value
Right.
adjustment, 227. Yep.
Exactly.
Okay.
So you have 185,000 that is showing up, in the asset side, if you like, of this acquisition. And this is a separate intangible asset which will be amortized as it is paid off.
Okay.
Yeah. As the money is collected, its value will go down.
Yeah.
And this is the point, again, I made this at the beginning as part of the moral hazard. If at the end of the expiration of the indemnification period, you have not used the money, you can run into an interest charge for saying these were all risky loans and FDIC had to commit money to this, but you never used it.
Okay.
Yeah. So that's on the asset side. But on the income side, the 67 goes straight into net income. This is what I was saying, that to me, this stands conservatism on its head, that all these numbers include future cash flows, which, are now being accrued onto the balance sheet. Yeah. All right. Okay. So what did we do? Now, as I said, I'm not so interested in the earnings management as trying to see if the accounting numbers that are reported eventually in the 10K reflect real economic value as considered by the investors in the initial market reaction. So to know this, basically the merger takes place. There's lots of articles in in the press. There's also some statutory documents. Those show, for example, how much is the indemnification asset. If you look at the merger of SVB, it'll tell you again how much there is in that article. Okay, so you know all this at the beginning, and so the investors respond to this right after the acquisition is announced. Okay, sometime later you have the 10K. And then we took it out for 12 months after the merger. So this whole period is 12 months. And we looked at, what happens in the next year? Is it consistent with what was reported in the 10K as a bargain purchase gain? How does this bargain purchase gain reflect to the initial market reaction? And how do we put those two together to try and explain what happened in the future returns. Okay, I just want to pause here again, see if the methodology is okay. Any questions?
So jumping back, I just thought it might be helpful at some point to discuss the accounting for badwill.
Accounting for?
Badwill as opposed to goodwill. So there is
Yeah.
called badwill under FAS 141. There's also
Right.
badwill under IFRS, and the treatments are different. So IFRS allows you to recognize an extraordinary gain, not an ordinary gain, but an extraordinary gain on the purchase. And so under US GAAP, you're required to write down assets, starting with the current assets and stuff. So there's a sequence in which you write down assets.
Not anymore.
Okay.
Sorry, so that's what has gone out of the window.
Okay.
That has gone out of the window, and you don't have to do that anymore. And that is what they did with 141R as opposed to 141.
Okay.
They took away that write down completely, and they put this directly into net income. Okay. So the idea is again that all tangible assets are at fair value. Why should intangible assets also not be at fair value? The problem is valuing intangible assets requires you to I mean, I don't know. It's just all level 3 valuation. So
what about intangible liabilities? Don't they exist?
Yes, liabilities are also done the same way. Yes. Yeah. Exactly the same way. Okay. Any other questions on this?
At least some of the intangible liabilities we do record, like warranty and other things, but we convert them into tangible liabilities, right?
Okay. Now I have to quote.
That's
Jim
like matching.
Lysenring.
You go into matching principles.
So I'm quoting Jim Lysenring. I've been trying to verify this. When we sent him the paper, his reaction was, A, BPG should not happen. That was his reaction 1. Reaction 2 was we created 278 intangible assets to which the purchase price can be allocated. Now, I've been spending time trying to find that list of 278 items. I have not found it, but I have found like about 25 big categories, okay, where you can do this. One of them, of course, being customer lists. You can relook at it on 141R, and there are lists, some major groups of intangible assets, which we never see on the balance sheet, except at times of acquisition. Yeah. So these are intangible assets that are normally never recorded, but because of this logic of trying to take things out of goodwill and put them into things where they can be tested more efficiently for impairment, they created this huge laundry list of assets into which you can put money, which you can allocate the purchase price.
So my question is, what about the intangible liabilities, like taking on more litigation risk, for example?
Yeah. So those are also supposed to be fair valued. Yeah, that's what it says. It says,
I've never seen one of those.
that, the treatment of assets and liabilities is symmetric. They actually say that in 141R, So yeah, so that's why I was a bit confused about Keishi's thing about future costs, because according to 141R, all those also have to be added as liabilities. Okay. Any other questions?
Atul?
Okay. So let me go down. So this is the basic thing again. We are trying to see what was the initial market reaction. Was the initial market reaction, basically we are trying to see, did the initial market reaction somehow correspond to the BPG, the bargain purchase gain, the negative goodwill, if you like, badwill, whatever you want to call it. How did that factor into the investor's reaction? And how did this carry over into the future? Okay, so here are the two. This was this paper we started off with. The acquisitions are entered into in order to structure the transaction as a BPG and boost earnings. This is your hardcore earnings management. And the one that we had is that BPG transactions where the FDIC are involved represent a strategic transfer of value to strengthen the acquiring firm. So as I said earlier, this follows from the logic of the FDIC that they have to minimize the total cost to the government of bank failures. If you can do that by letting the bank fail and paying depositors directly, that is better. Or if you can find someone to take them over, that might, and give some money to the acquirer, that might be cheaper than allowing the bank to fail. So that's exactly what they're supposed to do. Okay? Compare these options and do the one that is least expensive for the taxpayer. Okay, so this is what our group is. We have the FDIC assisted, we have the non-FDIC, we have goodwill acquisitions, bargain purchase acquisitions, and we look at some issues. How does the market reaction differ across all bargain purchase and all goodwill? How does the market reaction differ across BPG, FDIC, and non-FDIC? Is there evidence that BPG may have been inflated by loss firms? Does the future performance of the firm reflect the BPG? So these are the basic things that we're looking at. And to our, really the last question is, for me, the most interesting thing, or maybe the second and the last are the most interesting for me, as to how investors react to the announcement of a BPG. Oh. Okay, so many of the assets are shown in the 10K. They are known at the time of the merger. More elaborate disclosures are made in the 10K. What is the correspondence between market value change at the time of merger as compared with the BPG valuation disclosed subsequently in the 10K? This, if you don't mind my saying, is a Jim Olson question. He thinks markets should tell you something about what the accounting should be doing, and not accounting should be telling you something about what the markets are doing. So I'm channeling Jim on this. Okay. And also, does the relation between market gains and reported BPG, is it more consistent in the FDIC group or in the non-FDIC group? Then we have the question with the indemnification asset. Typically, the indemnification asset is a significant portion of the BPG. We looked at, I showed you one, you can see that the BPG was 67 million, but the indemnification asset was 185 million. So what this made us think was that, look, the acquirer is getting this big asset as future, loss indemnification. Is the value of this loss indemnification being factored into the acquisition price? Do you see what I'm trying to say? If the FDIC is providing some value to the acquirer, is this being split across the target and the acquirer, or is it all going to the target, to the acquirer? After reading the thing, we felt that it was all going to the acquirer. So in some sense, this is the factor that is driving the BPG. Okay. So this is the second thing we looked at. How does the value of the indemnification as reported in the 10K factor into the initial market return? All right. So the next table is also pure Jim Olson. He used to tell me, show me the correlation table, and I don't want to see any of the other tables. Just that one is good enough for me. Okay, so here is the correlation table. Okay. We have a dummy for the loss. So it's 1 if the firm is a loss before certain adjustments to income and bargain purchase gain. So if you're going to make a loss without the bargain purchase gain and some other factors, that just adjustment to income. So you can think of it really as loss without the bargain purchase gain. Then are you more likely to book a bargain purchase gain? Okay. Again, the same thing with decrease in ROA. If the return on assets decreases, are you more likely to book a BPG? The last thing was, if the target had a lot of real estate loans, is this more likely for you to book a BPG? The idea being that real estate loans had fallen. The market value of real estate loans were very low during the crisis, so you could buy these at bargain prices. Okay. Is that all right? So this one is that this is the likely source of the bargain purchase gain. This is the earnings manipulation story are in the first two, that if you're going to lose money, you book a BPG. This is the first thing we looked at. As I say, all these could be used to do both stories. Loss dummy, increasing BPG is earnings manipulation, decrease in ROA leading to BPG is again earnings manipulation. Target real estate, here is some place where you have a lot of flexibility because the market values were not reliable, so you could do that. We also found that the total amount of property, plant, equipment acquired and the size of the target, these two decrease the probability of a bargain purchase gain. Okay. But we also found a lot of other things: FDIC involvement, provision of indemnification, amount of deposits in the target, whether there was a cash payment by the acquirer, the intangibles acquired, all these increased the probability of a bargain purchase gain. Okay, we think that this is not really supported by the EM story, but more supported by strategic actions of the FDIC. Okay, for example, look at the amounts of deposits in target. This is a clear variable, right? If the target had more deposits, okay, then the probability of a BPG went up. Yeah, this is consistent with the FDIC trying to protect the depositors. So it's very consistent with that story, and it's not consistent with the earnings manipulation story, because the more cash you have, the less scope you have for, you cannot adjust that number. Okay. And the last thing, we got some strange results with the Altman Z. Again, this allows me to put one of my pet peeves. I think that the Altman Z is a very crazy variable, and I'll just leave it at that. Okay, so we got some strange results with Altman Z. All right. So in table 4, we found that the earnings decline increases the probability of BPG significantly only in the non-FDIC sample and not in the FDIC sample. Okay, so it wasn't really that the BPG was not really associated too much with the earnings decline in the FDIC sample, but in the NFDIC sample, if you were going to show less earnings, then you are more likely to book a BPG. Okay, we also found that indemnification was offered in most FDIC acquisitions and is significantly associated with the BPG. Cash payment was made only in non-BPG acquisitions. So if the acquirer made a cash payment, then we did not see any BPGs in those ones. Basically, these are, when the acquirer is paying cash, this means the target is in good shape. And so you will not be able to bargain them down to a lower value. Yeah. Altman Z was positively associated with BPG in FDIC samples and negatively in the NFDIC samples. I really don't know what to make of this, but I mean, here is a possibility. The acquirers are healthier in the FDIC BPG samples because the Altman Z scores are higher. Okay, so, but as I say, I always struggle with this variable. So next one was decline in ROA increases the probability of BPG only in the NFDIC sample. Again, this is something that is consistent with the story that in the FDIC sample, you're getting real bargains. In the NFDIC samples, you might be getting some hokey bargain purchase gains. Okay. The valuations of the acquired loans. This is the single largest fair value acquisition asset. Again, the manipulation of this might have contributed to the BPG, but only in the NFDIC sample. In the FDIC sample, because there's an indemnification asset, we would expect the valuation of the acquired loans to be very accurate. Oops, I want to go back up again. Keishi, I want do you want to make the comment about the TOBIT?
Yeah, so maybe in the table 5. Okay, so in this sample, this sample includes only BPG forms, right?
Yes,
So
that's correct.
so in that case, so there is no 0 BP gains. So you can, I think you can use ordinary least squares. So the sample is not censored. So usually, so if you investigate the determinant of impairments, then so control farms do not record impairments, but treatment sample record impairment. So in that case, so there are many observations with 0 impairments. Then you have to use TOBIT regressions. But in your sample, there is no 0 gain samples. So I think OLS is better.
Yeah, if I may put it slightly differently, the TOBIT 1, which we use, is really for a censored sample, right? Where you cannot observe the negative, you cannot see the negative goodwill. But here negative BPG, here we can see the negative goodwill. So this is sample selection by us. And there are we should have used a different TOBIT model. There are other TOBIT models which, which deal with the sample selection by the researcher rather than by nature. Okay, so I appreciate that point from Keishi. That's why I asked him to specifically comment on that, because that is correct. And we should use a slightly different TOBIT model on that.
Yeah,
I'm glad for that comment.
Sulipta suggests the Heckman selection model.
Yeah, Heckman selection model.
That would be good. Yeah.
That's what we should do. Yeah. All right. This last table is the one that
you have a question.
Yeah.
Not a question, but it's sort of a finding said a little differently than the way Bharat is. I kind of believe there is management of earnings. And when you start a study like this, which often, hey, we had these bargain gains, why should you see it? Is it management of earnings? But here, and this was a lesson, here when you carve out a subset, and we are carving out a subset, you see something different in interpretation. And in the earnings management studies, at least to my knowledge, I haven't seen the carve out in this way, and I haven't seen people looking specifically for this carve out. So it's really, for me, it was an extension of the way to look at earnings management and the way to look at firms, and that you have to intrinsically and forensically look at your samples. I'll shut up now.
Yeah. Ayum?
I just have a minor comment about table 5. So in table 5, there are 109 FDIC acquisitions and 25 non-FDIC acquisitions. And I think the R square from the TOBIC regression kind of like set an alarm, right? Because you have 25 observations, you have 19 right-hand side variables, including the year Frick's effects. I don't think there's a kind of like reliable inferences we can draw from this multiple regression. I still like the simple correlation model, like for this small sample size. But it's just not much we can do because right now the reported R square is minus 0.30, and then I don't know how to interpret that.
Yeah, I think we'll have to go back to table 5 and think about that again. You're absolutely right. But there is a general problem with the sample that the bargain BPG and the goodwill are not symmetrically distributed across the FDIC and the non-FDIC group. Yeah, yeah. And that's something we need to do. Yeah, Steve? Oh, forgot to take his hand down. All right. Let me go to table 6, which for me was, I mean, like I say, this all depends on, Steve pointed out what he found attractive was this fact that it clearly gave some insights into how earnings management works, that you see it in the non-FDIC sample, but you don't see it in the FDIC sample. Okay, so table 6 is looking at the investor reaction. Okay, so first thing we find is that if the FDIC was involved, there is generally a positive reaction. Okay, and then if there was a bargain purchase gain, this was 3.32% over 3 days. Okay, unfortunately, for exactly the reason that I pointed out, it's very difficult because the majority of our sample are BPIG, our FDC, our BPG acquisitions. It was very difficult to show. I mean, I thought 3.32 is so much higher, but it was still difficult because the sample is so skewed between the BPG and the non-BPG. Okay, but still 3.32 is good because most times mergers lead to negative. On average, mergers lead to a negative stock price reaction. So here, not only was it positive generally for the acquirer, it was pretty significant, 3% over 3 days. Okay. The non-FDIC BPG do not earn any significant return. So it looks like investors understood this, that maybe in the NFDIC case, the BPG is not really representing anything except some accounting manipulation. Okay. So that was the first one in this. And the second one we had in this is that the 1 to 12 month CAR, for me, this was the clincher, that the 1 to 12 month CAR for the FDIC BPG is 8.62%, in addition to the 3.32%. Okay, so there are different ways you can look at this, I mean, as to how you can test this in the future. Keishi again suggested maybe we should look at the loan write-offs to see if the loans themselves had been overvalued. We could do that, but the thing is we just looked at the 12-month CAR, and to me, this is a clincher that the FDIC BPG is so significant over the 12-month window, whereas the NFDIC is basically zero. So they don't gain anything. In fact, they lose something because they get a little positive bump in the first 3 days, and then they lose the money over the next 12 months. Ayu.
Yeah, my last question is that in terms of a sample, have you looked at non-bank bargain purchase gain transactions? You mentioned in your paper there are about 200 of them, right? And that would be a bigger sample for you to test non-FDIC hypothesis.
We already published that paper.
Oh, okay. I apologize.
I'll send it to you. Yeah, I asked our co-author Yan Yan to send me that paper, but she hasn't sent it yet. I have it somewhere. I'll send it to you. We looked at a separate paper where we looked. See, this is because we got this thing from the Jim Leisenring saying that, hey, this can't happen. But we found so many in the non-bank samples as well. And, we have a different paper on that. Yeah. What is surprising is the prevalence. I think it's certainly over 10% of all the acquisitions are bargain purchase gain. Okay. And why, whether this is real or not, that's a very difficult story. In the banking crisis, you can believe it's real because the banks were in so much trouble that they had to do fire sales. This is why we were interested in this in the first place. In the non-banks, it wasn't a fire sale, so you expect something different to happen. Yeah. I'll send you the paper, Ayuk, yeah. Okay, so let me just do the conclusion there. I'll take any questions that you have. So, okay, there's one more test that was a small surprise to us, that we found that the indemnification asset is highly correlated with FDIC, but it's also highly correlated with bargain purchase gains. So, as I said, my first instinct was that the value transfer was occurring through this indemnification arrangement. That is, the indemnification arrangement increased the value to the acquirer, but none of that value was transferred to the target. So this is like an extra inflow of cash from the FDIC, that this is what was creating the bargain purchase gain. But what we found was that the coefficient on this probability was to be negative. You know, if there was a high probability that the FDIC would give indemnification, that probability was actually negative in the CAR. So what we decided was that, look, this asset really measures risk. You know, the larger the asset, the higher the risk of the acquisition. And that is diluting the you know, if you like, it's the second moment coming in. It bumps up the bargain purchase gain, but it also increases the risk of these loans. And this was why we ended up with a negative on the indemnification asset, probability of being given an indemnification asset. We could not use it directly because there is such high correlation. Almost all the FDIC involvement also had an indemnification asset.
Okay, so Bharat, you
Yeah.
have 2 minutes. So
Yeah, I'm just
please
finishing
conclude
up.
in 2 minutes. Yeah.
Yeah, I'll just finish up. So here's our conclusion. ASC 805 has appended conservatism and created an avenue for accruing gain contingencies through the valuation of intangible assets. How is this being used by acquirers? This is only in the FDIC acquisition, so we think that there's not much earnings management going on. In the FDIC arrangements, the indemnification contracts are valued by the investors. They assign positive value to the FDIC BPG acquisitions, but not to the non-FDIC ones. Okay, so that's it. I'm done. And do you want me to put up the next thing, or you're going to announce it? Okay. Let me just see if I can put this up here.
Or we can have Sale Kim talk about the next event.
How do I close this? Escape. Sorry, give me 1 second. Close this. Screen sharing is stopped. Okay, give me 1 minute. I'll put it up.
So on April 2nd, Sewa Kim from Columbia University will present a paper co-authored with Stephen Ryan and Sale Kim. The title is Banks' Motivations for Designating Securities as Held to Maturity.
So I'm sorry, I finally got it up. Yeah.
Mm-hmm. Yeah.
April 2, Tuesday, 12:30 to 1:30. Sewa Kim. Yeah.
Thank you.
Thank you, Ayung. Thank you for including this paper. Thank you, everyone. And thank you especially Keiichi. We'll see you all on April 2nd.
Hi, Bharat. Sudarshan from India.
Hey, how are you?
I'm very fine. How are you?
Oh, yeah. So we are going all the way to India now.
Yeah.